Options and futures, right. They sound kind of like, well, a little intimidating, like something you'd hear on Wall Street, you know? But really, when you get down to it, they're just financial tools and they can be pretty useful, actually.
Yeah, definitely. And once you get past all the jargon, it's like
Yeah.
anything else in finance, right? Understanding the basics can really change the game for you, whether you're, actively investing or just trying to follow the news.
For sure, for sure. And that's why we're diving into this Investopedia article today. It does a great job at explaining it all in a way that, well, even I can understand.
And that's what's key.
Right. So let's jump right in, huh? The article starts by defining options and futures. Both kind of revolve around this idea of buying or selling something, like an asset, at a certain price, but on a specific date in the future. So far, so good, right?
Yeah, that's the basic idea, but that's kind of where the similarities end.
Okay, how so?
Well, the big difference, and the article really hits on this, is the obligation, the commitment.
Okay, I see where you're going with this.
Right. So with options, like the name suggests, you have a choice. You're not obligated to actually buy or sell. Futures, though, different story. It's a binding agreement. You're locked in.
So it's like with options, you're basically saying, hey, I might buy that later at this price, but futures are like, I am buying that later no matter what.
Exactly. That's a great way to put it.
Thanks. So let's say, okay, imagine a farmer, right? They're worried about the price of soybeans crashing before they can harvest.
Okay, I'm with you.
They could use a futures contract to lock in a good price now, today, and that way they're protected even if the market tanks later.
Exactly.
Hmm.
That's the beauty of futures. They're great for managing risk, just like you said.
Like insurance against, the market going haywire. And speaking of futures, I thought it was interesting how the article mentioned that it's not just about, like, agricultural stuff anymore.
Yeah, it's come a long way. You've got futures contracts for all sorts of things now. Stock indexes, interest rates, even crypto in some cases.
Wow, that's wild. So whether you're worried about the price of corn or the NASDAQ, there's probably a futures market out there for you. Okay, but let's get back to options for a sec. The article talks about two main types, calls and puts. Can you break those down for us a bit?
Sure. Think of a call option like this. Let's say you think a stock is going to go up, right? So you buy a call option, and that gives you the right to buy that stock at a certain price. We call that the strike price, on or before a certain date. Now, if the stock goes up above that strike price, you're golden, right?
You exercise your option, buy it for less than it's worth, and then sell it high.
Boom. Profit. Now, put options, on the other hand, are the flip side.
So you're betting the price is going down.
Exactly. You're buying the right to sell at that strike price no matter how low it goes on the market.
Interesting. So if you're like bearish on a stock, a put option lets you, make some money off that. But what about the risk with all of this? The article kind of made it seem like options are less risky than futures. Is that true?
Well, it depends. When you buy an option, the most you can lose is the premium, the price you paid for it. So yeah, in that sense, your risk is limited. But selling options, particularly these things called put options, well, let's just say the potential for loss there, a lot bigger. The article gets into it, and it's really important to understand.
Okay, so it's kind of like options seem less risky, but there's this whole other side to it, especially when you're the seller, like higher risk, higher reward, but for both sides.
He got it.
This is really interesting stuff. Now, the article used this example with gold, and I thought it was a great way to show the differences between options and futures in action. Can you walk us through that?
Yeah, that gold example is a really good one. It shows how, like, someone who's bullish on gold, maybe they think the price is going to go up, they could use options and kind of leverage their bet, right?
Okay, I see where you're going with this.
Like, they could buy call options on gold, and if the price shoots up, they make a profit. But they didn't have to put up all the cash to buy the actual gold up front.
Right, right. So it's like they're controlling a lot of gold potentially without actually owning it.
Exactly. But then on the flip side, you've got someone who actually wants the gold, right? Like a jeweler needs gold for their inventory. They might use futures contracts to lock in a specific amount at a set price. So no matter what happens to the market, they know they're covered.
Ah, that makes sense. So it's like options are for speculating, maybe making a quick profit. Futures are more for like the long haul, actually acquiring the thing.
You got it.
Mm.
And you know what's interesting? Most options and futures contracts, they never actually get exercised.
Wait, really? So people are buying and selling these contracts before they even like expire. What's the point of that?
Well, it's all about taking advantage of how the prices move. You don't always need to actually own the thing to make money. Let's say you buy a call option on, I don't know, a tech stock. You think it's going to go up, right?
Yeah.
Now, let's say you're right and the option's value goes up. You could just turn around and sell that option to another trader for a profit, and you never even touch the stock itself.
Oh, wow. So you're basically like trading the bet itself, not the outcome of the bet.
Exactly. It gets pretty meta. And futures, yeah, you can trade them before they expire too, but the whole system is kind of set up more for actually delivering the asset, like we were saying with the gold, right?
Right. A jeweler can't exactly sell a futures contract for like 1,000 ounces of gold and then have nothing to show for it when the contract comes due.
Exactly. That corn example we talked about before, that's a good one too. You
Yeah.
can't exactly just like magic up thousands of bushels of corn if you haven't grown them.
Nope. Speaking of corn, though, it seems like there's a real-world connection with futures that you don't always get with options. So for our listener who's maybe just starting to wrap their head around all of this, what would you say is the most important thing to remember when you're comparing options and futures?
Well, the article stresses this, and it's worth repeating. You really have to understand the risks involved. Like, buying options might seem safer because, at most, you just lose what you paid for the option. But selling options, especially those puts, you could be on the hook for a lot more. And futures, well, with that obligation we talked about, things can get pretty risky, especially if the market makes a sudden move against you.
Okay, so while options and futures can be useful tools, they definitely require a lot of like caution and careful planning.
No doubt about it. Informed decisions are key when you're dealing with these instruments. Now, you mentioned something earlier that I found really intriguing, things called options on futures.
Oh, yeah, the article touched on those. Sounded super complicated.
They can be,
Yeah.
but honestly, that's what makes them so fascinating. It's like instead of just having the option to buy or sell an asset, you have the option to enter into a futures contract on that asset.
Whoa, that's like next level stuff. Like we're talking about options on top of futures.
Pretty much. You're adding a whole other layer of like strategy and complexity to the mix.
I think we'll save that deep dive for another day. Our listener's head is probably spinning enough already.
Probably a good call. But hey, that's the thing about this world. There's always more to learn.
For sure. Speaking of learning, the article mentioned something called implied volatility when it was talking about options. Can you shed some light on that?
Absolutely. So implied volatility, it's a fancy way of saying how much the market thinks an asset's price is going to move around. The more volatile the asset, the more expensive its options are going to be.
Oh, that makes sense. So, like, if a stock is known for having these wild price swings, its options are going to be priced higher because there's a greater chance for someone to make a big profit.
Exactly. You got it.
Wow, it's like the market's pricing in the drama.
Right. Now, while we're talking about these, let's say, advanced concepts, we should probably mention contango and backwardation when we're talking futures markets.
Okay, those sound kind of intimidating, not gonna lie.
I know, right? Fancy words, but they're not as scary as they sound. Basically, contango and backwardation, they describe the relationship between the current market price of an asset and the price of its futures contracts.
Okay, so far so good.
So contango, that's when the futures price is higher than the current market price. Think of it like you're paying a premium to have that asset delivered to you later on.
So it's like paying extra for the convenience of not having to store a bunch of corn until you need it, right?
Exactly. Backwardation, though, is the opposite. It's when that futures price is actually lower than the current price. Happens sometimes when there's really high demand now, or maybe a supply shortage in the short term.
So using the corn example again, it'd be like, if everyone's desperate for corn right now, the futures price might actually be lower because whoever's selling those futures contracts knows they can get a better price if they just wait a bit.
That's a great way to put it. Contango, backwardation, these are key concepts in futures markets, and understanding them can give you a real edge.
This is all incredibly insightful. It's like we've really gone beyond just scratching the surface with this deep dive. It's amazing how, like, once you start to break it down, it kind of clicks, you know?
It really is.
Yeah.
And the deeper you go, the more you see how all these markets are connected. Implied volatility, contango, backwardation, it's all connected, driven by the same thing, supply, demand, what people are thinking, feeling about the market.
Right, right. It's all psychology too, isn't it?
Absolutely. It's like we've pulled back the curtain, right? Revealed the wizard behind it all.
A little bit, yeah. But let's bring it back down to earth for a sec, you know? Our listener's brain is probably working overtime right now. So if they only take away like 3 things from this whole deep dive, what would you say those should be?
3 key things, huh? Okay, let's see. First one, and this is a biggie. Remember, options, futures, they're not assets in themselves, okay? They're what we call derivatives. Their value comes from something else, a stock, a commodity, whatever it's based on.
right? So their value
Huh.
is like derived from something else. They're not the thing itself, but they're tied to the thing.
Nailed it. Number two, remember that difference in obligation we talked about, right? Options give you the right to buy or sell, but you don't have to. Futures, you're locked in, buddy.
Right, right. So it's like options give you a choice, but futures are making a promise.
Exactly. And number three, this is huge risk management. Both options and futures, they can be really powerful tools, but you got to respect the risks.
Don't bet the farm, right?
Unless you actually own a farm
Yeah.
and you're hedging with soybean futures.
Okay, good point. So, derivatives, obligation, risk. 3 words to live by in the world of finance. This deep dive, I gotta say, has been eye-opening, and honestly, I feel like we've just scratched the
Oh,
surface.
for sure. But that's the cool part. There's always more to learn, always something new to explore.
Exactly. So, to our listener, if you're feeling curious, go check out that Investopedia article we talked about. Learn more, keep asking questions, and remember, this world of finance, it's always changing, so don't get too comfortable.
Well said. Informed decisions are the best decisions.
So true. Well, on that note, we're going to wrap up this deep dive into the world of options and futures. Thanks for joining us.